There are many different types of permanent life insurance. The most traditional form is whole life insurance, which has more guarantees than any other form of permanent life insurance. Whole life insurance includes the following products: traditional ordinary, or straight, whole life; limited payment whole life; modified premium whole life; graded premium whole life; non-fixed premium whole life; index life; variable life. Whole life insurance has two distinguishing features. It guarantees the face amount, death benefit, for the insured's whole life. With one exception, it includes a guaranteed cash value that gradually builds inside the policy. The exception is variable life insurance. Its cash values are not guaranteed. What most differentiates one type of whole life from another are the length of time over which premiums are paid, how the policy's cash values are invested. Ordinary, straight, whole life. The most basic type of whole life insurance is ordinary whole life, also called straight whole life. With ordinary whole life, benefits and premiums remain level and payable through the insured's entire life. Think, whole life. Death benefits remain level, and level premiums are payable until the insured dies or reaches age 120, whichever comes first. Premiums are guaranteed to remain level despite the insured's increased likelihood of death with older age. Guaranteed cash value. A crucial part of every permanent insurance policy is its cash value. With whole life insurance, the cash value grows at a contractually guaranteed rate. This is necessary to support the guaranteed level death benefit and premiums. The cash value is funded by the premium. Permanent life premiums are generally higher than term premiums at any issue age, which is due in part to funding the cash value. The cash value continues to grow throughout the life of the policy, eventually equaling the face amount at policy maturity, age 120 for policies issued since 2009. At maturity, a life insurance policy is said to endow. Maturity, endowment, at age 120 is a federal requirement. More on this in the life insurance taxation lesson. The policy owner owns the cash value and may borrow against it while the policy is in force, though doing so will result in a reduced death benefit if not repaid. If the insured lives to age 120, policy maturity, the policy face amount is paid to the policy owner since it equals the cash value and there is no more pure insurance protection. Key point: how does whole life insurance support both a level death benefit and a level premium for life? There are several factors behind the level premium concept, but the simplest explanation lies with the cash value's relation to the policy's net amount at risk, that is, the pure insurance component of the policy. As illustrated here, the net amount at risk decreases at the same rate the cash value increases, which maintains a level face amount, death benefit. The decreasing net amount at risk, pure insurance, offsets the rising mortality charge that comes with age, allowing the premium to remain level. Working together, they are able to support both a level face amount and a level premium. Limited payment whole life. Like ordinary whole life, limited payment whole life insurance provides level death benefit protection for the insured's whole life with a level premium. The main difference between ordinary whole life and limited payment whole life is the time over which premiums are paid. Limited payment life insurance policy premiums are payable over a shorter time than ordinary life premiums. The trade-off to the shorter premium period is that premiums are higher than they would be with a straight life policy of the same face amount. That is, higher premiums are payable for a shorter period. On the other hand, the higher premiums mean the cash value grows more quickly during the premium paying period than it would with a straight whole life policy over the same period. Limited payment life insurance premiums can be paid for a specified number of years or to a specified age. A policy with a 10-year premium period is called a 10-pay life policy. One that requires premiums to age 65 is called a life paid up at 65 policy. See illustration. At the end of the payment period, the policy is said to be paid up. Single premium life. The most extreme example of limited pay life is the single premium life insurance policy, which is paid up with the payment of a single premium at the time of purchase. Tax law changes in 1988 diminished the appeal of single premium life by designating these policies as modified endowment contracts, MECs, and removing some of the tax advantages normally enjoyed by life insurance. This is covered in a separate lesson on life insurance taxation. Modified and graded premium whole life. Two common variations of ordinary whole life insurance are modified premium whole life and graded premium whole life. Both feature a lower initial premium than straight whole life of the same face amount, but premiums increase to a higher level after a certain time. The chief difference between the two products lies in how the premiums increase over time. With modified premium whole life there is a single increase, typically 5 years after policy issue, with premiums remaining level thereafter. Graded premium whole life starts with an even lower premium, but premiums increase in a series of steps until they, too, become level for the remainder of the premium period. The grade-in period during which premiums increase may range from 10 to 15 years. Modified and graded premium policy cash values grow more slowly in the early years, due to the lower premium, but accelerate when premiums increase until they eventually equal the face amount at policy maturity, age 120. Non-fixed whole life products. Straight, limited pay, modified, and graded premium whole life products all share a common trait: they have fixed premiums. That fixed amount may increase at times, as with modified and graded premium policies, but in all cases the policy owner knows from the outset what the future premiums will be. These long-term fixed premiums are possible because they are based on conservative long-term interest rate guarantees. Beginning in the 1970s, life insurers began introducing products based on current, not guaranteed, interest rates. This meant the premiums, and sometimes the death benefit, could change unexpectedly over time to reflect changing interest rates. Once the insurer changes the premium, policy owners are obligated to pay the new amount. Non-fixed whole life products include indeterminate premium whole life, current assumption whole life, interest-sensitive whole life, indexed whole life, variable life insurance, indeterminate premium whole life. Indeterminate premium whole life insurance is issued with two premium rates: low introductory rate, guaranteed maximum rate. The policy owner pays a low introductory fixed rate for the first several years, after which the insurer uses its actual mortality, interest, and expense experience to establish a new current premium rate. Premium adjustments may be made as often as once a year, though this varies by insurer. The new rate is guaranteed to never increase beyond a maximum rate specified in the contract. Current assumption and interest-sensitive whole life. Current assumption whole life and the closely related interest-sensitive whole life have premium rates that can change in response to the insurer's actual mortality, interest, and expense experience. Unlike indeterminate premium whole life, in which premiums can only increase, these policies may experience premium decreases as well as increases. The insurer sets a minimum interest rate to be credited to the policy and a maximum premium rate when the policy is issued. If the insurer's actual experience is better than expected, then premium rates are lowered. If the insurer's actual experience is worse than expected, then premium rates are increased. Premium rates are changed based on a review and revaluation of the insurer's assumptions. The process insurers use to evaluate their actual experience and to apply the changes to their premium rates is called redetermination. Key point: while they share many of the same policy features, there are some notable differences between interest-sensitive whole life insurance and current assumption whole life insurance. Only current assumption whole life guarantees a minimum interest rate and cash value. The interest credited to an interest-sensitive whole life policy is not guaranteed, and thus the cash value is not guaranteed. Current assumption whole life policy owners have no control over how or when the premium changes, and the death benefit, face amount, does not vary. Interest-sensitive whole life policy owners do have some control over changes to the premium and face amount. If the insurer's redetermination results in a higher premium, then the policy owner can choose to either accept the higher premium or reduce the face amount of the policy and keep the lower premium. Indexed whole life. Indexed whole life insurance keeps pace with inflation by tying its death benefit to a cost of living index, most commonly the Consumer Price Index, CPI. Over time, the policy's face amount increases automatically with CPI increases. As the face amount increases, so too does the premium. Insurers offer two pricing methods for the premiums associated with a face amount that increases over time. The premium increases every year to a new fixed amount to provide for the increased coverage. A level premium is set at policy inception and is based on assumptions about expected increases. This premium is higher at the front end but averages out over time. With an indexed policy, the policy owner does not need to prove insurability each time the face amount increases. Variable life. Consumer pressure on insurers to develop a product that truly reflects the investment performance of its underlying assets in the 1980s led to the development of variable life insurance. Unlike traditional whole life, variable life insurance includes an investment feature. Because of this, variable life policies are regulated as a security, like stocks, bonds, and mutual funds. The nature of variable life insurance. With traditional whole life policies, insurers invest the premiums in conservative assets that are managed in their general account. This, in turn, lets the insurer safely guarantee rates of return on the cash values. Variable life insurance, VLI, differs from traditional whole life insurance in the way its premiums are invested. VLI policy values are invested in investment accounts, known as subaccounts, which are selected by the policy owner and managed in a separate account outside of the insurer's general account. Subaccounts consist of a variety of stocks, bonds, and related securities. VLI policy owners assume the investment risk of policy values allocated to subaccounts. Like all securities, separate account investments are not guaranteed, which means VLI cash values are subject to declines as well as increases. VLI policies offer a wide variety of subaccount options, in some cases 20 or more. VLI policy owners can transfer funds between each subaccount. They can also transfer funds between subaccounts and the insurer's general account, although insurers may restrict the frequency of some transfers and limit the amount that can be allocated to the general account to something less than 100%. Consumers who want to invest 100% of their premium in the insurer's general account should consider a traditional whole life policy. Fixed premium and guaranteed death benefit. Like traditional whole life, variable life requires a fixed premium on a scheduled basis. It also guarantees a minimum death benefit. However, unlike traditional whole life, there is a possibility that the death benefit will increase above the guaranteed face amount. It all depends on the investment performance of the subaccount selected by the VLI policy owner. Non-guaranteed cash value. Unlike the death benefit, the VLI cash value is not guaranteed. If values decline due to poor investment results, the cash value will decrease. A variable life policy's cash value at any time is equal to the value of the policy's shares in its chosen subaccounts plus the value of funds allocated to the guaranteed fixed account. Key point. The death benefit of a variable life insurance policy fluctuates up and down but is never less than the guaranteed face amount. The cash value, on the other hand, has no minimum guaranteed amount. If the VLI insured dies with a diminished cash value, the insurer effectively makes up the difference so that the minimum guaranteed death benefit can be paid. VLI contract charges and fees. VLI policies have charges and fees that traditional whole life policies do not, all of which must be described in the policy's prospectus. Common VLI policy charges include a policy administrative expense or operational charge, a charge to cover separate investment accounts investment advisory fees. These fees may be charged monthly or annually, and they may be either a percent of the policy's face amount or a percent of the cash value. Regulation of VLI. Because of their investment nature and the inherent risk to principal, VLI policies are considered securities as well as life insurance. As insurance, they are regulated by each state's Department of Insurance. As securities, they are regulated by the Securities and Exchange Commission, SEC, the Financial Industry Regulatory Agency, FINRA, state securities agencies. As with many other types of investment product sales, All variable life sales must be accompanied by a prospectus that provides details of the product and its investment characteristics. Agents who sell variable life insurance products must hold both a life insurance license and a FINRA Series 6 or 7 registration. For your review, whole life insurance features more guarantees than any other form of permanent life insurance available today. With whole life, benefits and premiums remain level through the insured's whole life. The cash value is funded by the policy owner, as part of the premium. It is an essential part of the death benefit. The main difference between ordinary life and limited payment life is the period over which premiums are paid. Premiums for limited payment life insurance policies are payable for a shorter time than ordinary life premiums. With modified and graded premium whole life, premiums start lower but end up higher than straight whole life. Indexed whole life insurance keeps pace with inflation by increasing the death benefit to a cost of living index, most commonly the Consumer Price Index, CPI, without the need for evidence of insurability. Current assumption whole life and interest-sensitive whole life premiums can change in response to the insurer's actual mortality, interest, and expense experience. VLI policy values are invested in investment accounts, known as sub-accounts, that are kept in a separate account apart from the insurer's general account. VLI cash values are not guaranteed and may decline as well as increase. The VLI death benefit may increase but is guaranteed to never drop below the face amount at policy issue. Please pause the audio and watch the video. You can restart the audio playback.
To fully understand permanent life insurance, it's necessary to grasp the concept of the level premium. You'll hear people try to explain the level premium of whole life insurance by saying something like, with whole life insurance, you pay more in the early years, and that money is set aside in a cash value, and in the later years when you get older and the cost of insurance gets really expensive, that cash value helps to keep the level premium. Well, that's an easy concept to explain, but it's just not true. The explanation for the level premium of whole life insurance really begins with understanding the basic idea between the premium of a decreasing term life insurance policy. Now, if you understand term life insurance, you understand it's temporary insurance protection. And every year that goes by with term life insurance, the cost of insurance increases. It's pure life insurance. Your risk to the company increases every year. The premium is going to go up every year. Yes, I know. Insurance companies have different ways to levelize the premium of term life insurance. But generally speaking, a characteristic of term life is that premium goes up every year, with one exception. There is a type of term life insurance called decreasing term life insurance that does feature a level premium. And it makes sense. With decreasing term life insurance, every year that goes by, the amount of pure insurance protection decreases. And that decrease is offset by the increasing cost of insurance. So as the amount of protection goes down, the cost of insurance is going up. Those two forces offset each other. The net result is a level premium. Now, if you look at a diagram of a whole life insurance policy, what do you see? You see basically a policy that has a decreasing amount of pure insurance protection and something different. It has an increasing amount called the cash value. The decreasing term insurance protection, the decreasing amount of pure insurance protection, and the increasing cash value level out to equal the level death benefit. Where does the level premium come from? Go back to that discussion we just had about decreasing term insurance. The level premium of whole life insurance is earned by the simple fact that the net amount at risk, if you will, the decreasing term protection built into that whole life policy, allows that premium to remain level. So where does the cash value come from? That level premium is elevated, and that extra amount goes to build the cash value. It's the cash value and the decreased amount of pure insurance protection that equals the level face amount. But it is the fact that the net amount at risk is decreasing that allows whole life insurance and all forms of permanent life insurance to have a level premium.
Okay, everybody, so here is the 4 questions for this chapter. All the following statements about ordinary straight whole life insurance are correct. Which one is wrong? I want to say premiums remain level. Which one of the following statements about indexed whole life insurance is correct? There are two different premium plans available to indexed whole life insurance policies, with one plan starting out lower than the other. I don't think it combines whole and term. I don't think you can do that, but I could be wrong. So if anybody knows, answer below. Alright, a cash values may decrease as well as increase. The policy owner may adjust the policy premium up or down. I think I'm going to go with this one. A producer must be registered with the FINRA to sell which of the following? Variable life insurance and determine a premium whole, ordinary whole life insurance, interest sensitive. I can't remember, but I'm going to go with ordinary. Barb, age 40, buys a 10-year life policy. Buys a life policy up to 65. Oh, Barb buys a 10-pay life policy. Jill, age 40, buys a life paid up until 65. All other factors being equal, which of the following is correct? Jill will probably have to pay more eventually. They pay approximately the same monthly premium every year, but Barb's policy will mature before Jill's. Okay, that's correct. Is most correct. Barb and Jill will pay approximately the same amount, and then their policies will mature at the same time. Barb will pay a higher premium over shorter time than Jill. Jill will pay a higher premium than Barb. I don't know. That's a tough one. Alright, let's see. I only got one right here, so I didn't do very good. And it definitely won the last one. Okay, this last one would be Barb will pay a higher premium over a shorter time than Jill, and their policies will mature about the same time. Barb, who's only got a 10-year plan, will pay a higher premium. The shorter the premium paying period, the higher the premium. So that is charged for a limited pay life insurance policy, and all permanent life insurance policies mature at 120 if you reach that age. Alright, number 3. The answer was variable life insurance. That's what you got to be registered with FINRA to sell variable life insurance. Alright, this one is the only one I got correct. There are two different premium plans available to index whole life policies, one with starting out with a lower premium than the other. And this one is the death benefit increases during the early policy years, and then it levels off. Premiums never increase, despite the insured's increased chances of death as they age. Instead, level premiums are paid. This is for ordinary straight whole life insurance. The death benefit increases during the early policy years, and then it will level off. Alright, this was kind of a long chapter, but the next one is going to be flexible permanent life insurance. Okay, I'll see you all in the next video.